What Warren Buffett says about the 2026 market crash warning. Why Buffett's words matter for 2026. Warren Buffett isn't just a billionaire investor. He's a guiding voice of reason in markets often dominated by hype, speculation, and emotional panic. As 2026 approaches, financial analysts and media outlets are buzzing with warnings of a potential market crash. Headlines talk about overvalued stocks, rising inflation, geopolitical tensions, and possible interest rate hikes. Many investors feel anxious, unsure of whether to hold, sell, or buy. Yet Buffett's approach is fundamentally different. He doesn't try to predict market crashes with precise timing. Instead, he prepares for them and teaches others how to respond wisely. For Buffett, downturns are not moments of fear. They are opportunities to identify value, preserve capital, and grow wealth. Buffett's insights are rooted in decades of investing through booms, busts, and crises. From the dot-com bubble to the 2008 financial crisis and the COVID-19 market turbulence, he has consistently demonstrated the ability to protect capital while finding opportunities where others see only fear. Understanding what Buffett says about 2026's market risks isn't just about avoiding losses. It's about positioning yourself to thrive, no matter the economic climate. By following his principles, investors can learn to think like smart money, patient, disciplined, and principle-driven, even when markets are turbulent. In this video, we'll explore what Buffett actually says about market crashes and volatility, historical lessons from his past investments and warnings, practical steps for protecting and growing wealth in 2026, how to think independently, like smart money, rather than panicking with the herd. By the end, you'll understand why crashes aren't to be feared, but respected, and how to leverage them strategically to grow your wealth. Buffett's philosophy on market crashes. Buffett's famous quote, "Be fearful when others are greedy, and greedy when others are fearful," perfectly encapsulates his approach to market warnings. Let's break this down in detail. 1. Market volatility is normal. Markets fluctuate constantly. Short-term gains and losses are inevitable, and trying to predict every market swing is a losing strategy. Buffett instead focuses on long-term value, understanding that temporary declines often hide great buying opportunities for patient investors. 2. Avoid following the herd. One of Buffett's most important lessons is that panic is contagious, but opportunity is often hidden in fear. When markets drop, many investors sell impulsively, locking in losses. Buffett looks where others see risk, buying high-quality companies at discounted prices. Over time, these decisions often reward him far more than chasing hype ever could. 3. Value over speculation. Buffett avoids speculative bubbles. He focuses on companies with intrinsic value, predictable earnings, and durable competitive advantages. He doesn't chase trends or hot tips. He evaluates businesses based on their fundamentals and their ability to generate long-term cash flow. For 2026, Buffett's message is clear. The market may experience volatility, but panic rarely leads to profit. Those who remain patient, rational, and disciplined will often find themselves in the most advantageous position. Historical lessons, Buffett and past crashes, expanded with more depth. To understand Buffett's approach in 2026, we must examine his actions during previous market crises. History provides practical lessons for today's investors. The dot-com bubble, 2000. During the late 1990s, technology stocks were soaring. Investors bought companies with little or no profit, driven by hype rather than fundamentals. Buffett avoided the frenzy entirely. He focused instead on companies with proven earnings, strong cash flow, and durable competitive advantages like Coca-Cola and American Express. Buffett's key lesson: do not buy into hype. Trend chasing often results in short-term gains followed by long-term losses. The dot-com crash wiped out trillions of dollars for investors who ignored fundamentals. Meanwhile, Buffett's portfolio remained strong because he stuck to what he understood. 2008 financial crisis. During the 2008 global recession, panic swept the market. Stock prices plunged, banks teetered on collapse, and investors feared systemic failure. Buffett didn't panic. Instead, he bought stakes in high-quality financial institutions, such as Goldman Sachs and Bank of America, securing favorable terms, including high dividends and preferred shares. His actions demonstrated three principles. 1. Focus on quality. Buy companies with solid balance sheets and competitive advantages. 2. Be opportunistic. Downturns create opportunities to acquire value at discounted prices. 3. Think long-term. Temporary market fear should not dictate your investment strategy. COVID-19 market crash, 2020. The pandemic caused a sudden, sharp market sell-off. Companies temporarily lost value due to panic, even if their long-term fundamentals were sound. Buffett maintained significant cash reserves while selectively investing in businesses with durable competitive advantages and resilient cash flows. Lesson for 2026: patience and preparedness are more powerful than panic. Investors who stick to principles during turbulent times often outperform those who react emotionally. The 2026 market, potential crash triggers. Buffett rarely predicts exact market movements, but he often identifies risk factors that investors should monitor. For 2026, potential triggers include: 1. Overvaluation. Stocks may rise beyond intrinsic value, creating the risk of corrections. Buffett cautions against investing based on hype or momentum alone. 2. Rising interest rates. Central banks may tighten monetary policy to control inflation. Higher interest rates increase borrowing costs, potentially slowing economic growth and impacting earnings. 3. Geopolitical tensions. Conflicts, trade disputes, and global uncertainty can spook investors, triggering sudden market swings. 4. Economic slowdown. Recessions or slowing growth affect earnings, particularly in cyclical sectors such as travel, real estate, and manufacturing. Buffett doesn't react with panic. Instead, he emphasizes preparation, cash reserves, and disciplined evaluation. His approach reminds investors that understanding risk is more important than trying to time the market perfectly. Buffett's advice on navigating volatility. Buffett provides practical guidance on how investors can survive and thrive during periods of market turbulence. Hold quality companies. Focus on businesses with strong fundamentals, consistent earnings, and durable competitive advantages. Examples include Coca-Cola, Apple, and Berkshire Hathaway's core holdings. Don't try to time the market. Guessing the exact moment of a crash is nearly impossible. Instead, concentrate on buying companies with intrinsic value and holding them long-term. Maintain liquidity. Buffett emphasizes cash readiness. Having available capital during downturns allows you to buy undervalued companies while others panic. Think like an owner. Treat your investments as if you own the entire company. Understand how the business makes money, its competitive position, and its growth potential. The underlying principle: preparation and patience consistently outperform fear-driven decisions. Sectors likely to withstand a 2026 crash. Buffett's portfolio provides strong clues about which sectors tend to be crash-resistant. These industries consistently show resilience during downturns, often because they serve essential human needs or generate predictable cash flows. 1. Consumer staples. Essentials like food, beverages, and hygiene products remain in demand regardless of economic cycles. People still need to eat, drink, and maintain basic hygiene even during recessions. Companies such as Coca-Cola, Procter & Gamble, and Kraft Heinz exemplify businesses with predictable earnings and strong brand loyalty. Buffett often invests in these companies for their stability and compounding potential, especially during market turbulence. 2. Healthcare. Healthcare is another defensive sector. Aging populations, chronic diseases, and increasing medical needs create consistent demand. Pharmaceuticals, medical device companies, and healthcare service providers tend to remain stable when other sectors falter. Buffett has historically recognized the long-term growth and necessity of healthcare, making it a prime candidate for smart money in 2026. 3. Utilities and energy. Utilities generate stable cash flows because electricity, water, and gas are fundamental necessities. Even during downturns, revenue is steady and dividends remain reliable. Energy infrastructure, particularly renewable energy, is increasingly seen as essential and future-oriented, aligning with Buffett's philosophy of investing in durable, high-demand sectors. 4. Financial institutions. Banks, insurance companies, and investment firms can survive downturns if they are well-capitalized and conservatively managed. Buffett's historical investments in Goldman Sachs and Bank of America during crises show that these institutions can also provide strategic opportunities when markets undervalue their worth. 5. High-quality technology. While Buffett is historically cautious with tech, he invests when companies demonstrate predictable revenue streams and essential services, like payment processors, cloud infrastructure, and cybersecurity firms. In a 2026 downturn, technology companies with durable business models can withstand market volatility and offer attractive entry points for disciplined investors. Key takeaway: Buffett looks for companies that provide essential goods or services, strong cash flow, and durability, not the flashiest or most hyped stocks. By focusing on these sectors, investors can emulate smart money even in turbulent markets. Psychological lessons: how Buffett thinks differently. The market crash warning in 2026 is as much about human behavior as economics. Buffett's edge has always been psychological, rooted in his mindset. Understanding this can give investors a tremendous advantage. Emotional discipline. Markets are unpredictable. Investors often act on fear or greed. Buffett remains calm during crises, carefully evaluating opportunities while others panic. Emotional control allows him to buy low and avoid costly mistakes. Independent thinking. Buffett doesn't follow trends blindly. He analyzes businesses based on fundamentals rather than news headlines or social media hype. Independent thinking allows investors to identify hidden value that others overlook. Long-term focus. Buffett measures success over decades, not days. While short-term fluctuations may cause anxiety, long-term compounding amplifies wealth. Investors who adopt this mindset focus on durable businesses and steady growth rather than chasing immediate gains. Opportunity-oriented. Crashes are not threats to Buffett. They are chances to acquire quality assets at discounted prices. This mindset turns fear into a tool, creating strategic advantages in volatile markets. Buffett's potential 2026 investments during a crash. Although Buffett never reveals trades in advance, history provides clues about how he might act if a 2026 market crash occurs. 1. High-quality financial institutions. During previous downturns, Buffett invested in well-capitalized banks and insurers. In 2026, he may target companies with strong balance sheets, ethical leadership, and low debt. These investments often yield stable dividends and long-term growth, even when the broader market suffers. 2. Consumer staples and essentials. Even during recessions, people continue to purchase essentials. Buffett may acquire undervalued food, beverage, and household product companies. Their predictable earnings make them resilient and profitable, ideal for long-term portfolios. 3. Utilities and infrastructure. Utilities and infrastructure projects generate steady cash flows and are less sensitive to economic cycles. Companies with consistent dividends, government-backed projects, or monopolistic advantages could be Buffett's targets during volatility. 4. Technology with predictable revenue. Buffett invests in technology companies only when they provide recurring, essential services. Payment processors, cloud service providers, and cybersecurity firms could attract investment if market fear temporarily depresses their stock prices. 5. Energy and renewable resources. Energy demand continues to rise globally. Renewable energy projects also gain momentum, and Buffett may deploy capital in companies offering long-term growth and essential services, while the market is temporarily fearful. Pattern summary. Buffett seeks companies that are undervalued, essential, and resilient, allowing him to thrive while others panic. Step-by-step action plan for investors in 2026. Here's how individual investors can emulate Buffett during a market crash warning. 1. Assess your portfolio. Identify core holdings with durable competitive advantages and consistent cash flow. Reduce exposure to speculative or hype-driven assets. 2. Maintain liquidity. Keep cash reserves ready to seize opportunities when high-quality stocks fall below intrinsic value. Buffett often emphasizes that cash is a strategic weapon during downturns. 3. Focus on fundamentals. Study earnings, debt levels, and competitive positioning. High-quality companies often remain resilient even when markets tumble. 4. Diversify strategically. Invest across sectors that Buffett favors: consumer staples, healthcare, financials, energy, and select technology, while avoiding unnecessary over-diversification. 5. Adopt a long-term mindset. Ignore short-term market swings. True wealth comes from patiently holding undervalued assets and allowing compounding to work. 6. Think like an owner. Understand each business as if you owned it entirely. Evaluate management quality, market position, and long-term growth potential. 7. Stay calm during volatility. Rational decision-making during fear-driven sell-offs creates opportunities. Discipline and patience are more valuable than speed or impulsive action. Risk management strategies inspired by Buffett. During potential crashes, protecting capital is as important as seizing opportunities. Do over-leverage. Borrowing to invest amplifies risk. Buffett avoids unnecessary debt, maintaining a strong balance sheet for Berkshire Hathaway. Evaluate debt levels. Companies with low leverage survive downturns more easily. Look for manageable debt-to-equity ratios. Assess margin of safety. Purchase stocks below intrinsic value to provide a cushion against further declines. Avoid speculative fads. Cryptocurrencies, meme stocks, and highly leveraged ventures are extremely risky in volatile markets. Reinvest wisely. Use dividends and cash flow to reinvest in undervalued assets. Compounding accelerates wealth creation over time. Risk management is not fear, it is strategic preparation. Buffett's method ensures both capital preservation and growth, even when the market is uncertain. Buffett's moves during past crashes. Analyzing historical crashes shows patterns investors can replicate. 2008 financial crisis. Buffett invested in Goldman Sachs and Bank of America at discounted prices, securing favorable terms and high dividends. Dot-com bubble. Buffett avoided tech speculation and focused on proven businesses like Coca-Cola and American Express. COVID-19 market crash. Berkshire Hathaway retained cash and selectively invested in strong businesses with temporary price declines. Lesson for 2026: panic is the enemy. Identify strong, undervalued businesses and hold the course while others react emotionally. Turning 2026 market fear into opportunity. The 2026 market crash warning is not a signal to panic. It's a call to prepare. Buffett's principles can guide investors. Focus on quality over fear. Prepare for volatility without being paralyzed by it. Seek opportunities during downturns, not only when markets soar. Think long-term and act with discipline. Markets will fluctuate, headlines will create anxiety, and many investors will make impulsive decisions. By adopting Buffett's mindset, you can position yourself like smart money, ready to thrive during uncertainty. Buffett reminds us, opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. 2026 may present one of those golden moments. Your advantage comes from preparation, patience, and principle-driven investing. Key takeaways for investors. Preparation is everything. Cash reserves, portfolio assessment, and research are crucial. Patience beats panic. Long-term thinking and discipline outperform short-term reaction. Focus on value and durability. Essential businesses with strong cash flow are resilient. Think independently. Avoid herd behavior and hype-driven investments. Opportunities exist in fear. Market downturns often reveal undervalued companies. By integrating these lessons, investors can emulate Buffett's approach and potentially thrive in 2026, regardless of market turbulence. If you found this video valuable, comment below with your thoughts on Buffett's 2026 strategy. Share with friends who want to invest wisely. Subscribe for more actionable insights from the world's smartest investors. This video is for educational purposes only and is not financial advice. Always consult a licensed financial advisor before making investment decisions. Investing carries risk, and past performance does not guarantee future results.